Hello, everybody. Welcome to another Self-Directed IRA Saturday. Thank you for joining us today. My name is Andrea Chassin, and I'm an IRA specialist here at Quest. We are very excited today. We have Matt Allen joining us with a great presentation on an amazing topic on debt leveraging, non-recourse loans on self-directed IRAs. So I hope you guys enjoy it. It's going to be great. Before we get started though, and as per usual, we're going to go through some housekeeping. So first thing to note is our disclaimer. Of course, Questrust Company does not provide tax, legal, investment, or structuring advice or endorse any product, services, or investments of any type. So if you guys are looking for more advice, you go ahead, please, and reach out to attorneys, accountants, financial advisors for this, okay? So make sure to do that. I also want to share with you our QR code if you like to talk about IRAs with us, if you have questions, if you'd like to know more about today's topic or any topic IRA related, go ahead and scan this QR code and book a consultation with one of us, one IRA specialist, okay? We're always happy to help you guys and take you through your self-directed IRA investing journey. Also want to remind you guys of our rewards for deposit promotion we have going on. It actually got extended. It was supposed to be over at the end of June, and it got extended now for one more month because it's really great. And so make sure to take advantage of this. This is for all new clients as well as existing clients. So if you are looking to do an investment and kind of have been waiting and pondering about it, this is now your chance to move over funds, get credits, and invest your funds there. Okay. Again, let us know how to do this. This is a really cool and exciting event that we have going on. It's instead of our usual social that we have every Tuesday at our Houston, Dallas, and Austin offices. We are going to have a special one the month of July that we're excited about. It's going to be strictly networking and deal pitching. So it's going to be really interesting. We're going to have amazing Hawaiian food and, of course, drinks as per usual. So make sure to sign up and join us for this luau link up event that we have coming up. Again, that's for networking. And then we're also really excited about this Elite Multifamily Summit that is happening in Dallas. Tickets are going fast, guys. So make sure to let us know and grab your tickets if you're going to be in Dallas for this weekend. It's going to be amazing. It's going to be really interesting. It's got lunch included too, and snacks and coffee. So yes, and actually, there's about 1 or 2 more weeks that we're doing the pre-sale. Early bird tickets, and as well we have other promotions and discounts. So get one of us IRA specialists here for those. I think that's all I got for today. So without further ado, I would like to bring Matt Allen up. Please, guys, make sure to add your questions in the chat. Whenever you have any questions, just throw them in the chat, and we'll have a Q&A session at the end where Matt will be able to answer all your questions, okay? So make sure to do that. And let's have Matt come up. Hi, Matt.
Hi, Andrew. How are we doing?
Thank you for being here. Great. Go ahead. Take it away, please.
Okay, great. Thanks. Hi, everyone. My name is Matt Allen, and I'll be up front. The slides, some of them didn't format correctly when we uploaded them, so you may see some jumble, but I think it only impacts a couple of them. But again, I apologize for that. Again, I'm Matt Allen with North American Savings Bank. I have been with the bank for 20 plus years and focused on non-recourse loaning. So I know that's why most of you are here. To learn more about how can you leverage your retirement plan that you've created to purchase real estate, and then there's options to get lending to that specific vehicle, which allows you to obtain real estate with not all your money out of your pocket. So there's definitely some advantages to this, and I want to educate you on this opportunity, and for some of you, it may be a good fit. But again, let's get started. The advantages of debt financing, what are they? This is what we're going to cover. How do you get a non-recourse loan to purchase real estate within an IRA? And then what does a lender typically look for? What are the differences between a non-recourse loan and one that you've purchased in your personal name, say your primary residence? There's some pretty big differences that are really simplified as far as the underwriting piece that I think you're going to enjoy. As far as the red tape that they always call it with getting a loan, how that can be simplified. Here's one of the slides where it is a little bit overlapped, but North American Savings Bank. For those of you not familiar with us, we're a federal savings bank based out of Kansas City, Missouri. We've been around for almost 100 years. We have $2+ billion in assets. And then we offer a lot of portfolio products. That's what we focus on. You've got Fannie Mae, Freddie Mac loans where, it's kind of a box. Do you fit within that when you're buying a primary residence, a specific FICO, DTI, down payment, et cetera. So products that we think outside the box, kind of a creative way of looking at lending. Couple options. We have a bank statement loan for individuals that are self-employed or entrepreneurs that can't use their tax returns because of the deductions. This is a way to still get a loan. A DSCR loan, which stands for debt service coverage ratio. Those are for investment properties in your personal name where, again, you don't have to provide documentation about your income or employment. It's strictly based on the cash flow of that specific property. And then the last one is what we're going to focus on today. And that is a non-recourse loan that can be utilized with any self-directed product. Now, I'm going to use the term IRA for the majority of the presentation, but just know that if you have an IRA LLC, solo 401k plan, a partnership, anything that within the plan documents allow for true diversification, as far as self-directed with real estate, then that would apply for this type of loan. So the first piece is, how do you acquire real estate within a retirement plan? And there's 3 ways to do that. The first one is pretty easy. You purchase it outright with cash. So you have a $200,000 home. You have that amount of money in your self-directed IRA. So at the closing table, $200,000 comes out of that account. You own that property free and clear, and all profits go back in that IRA with no mortgage to pay. Second option is you partner with another investor. So whether that's an IRA or an LLC or an individual, let's say that same $200,000 property, you only have $100,000. You partner with another individual. That remaining 50%, you both put the cash in, and then the 2 parties own that property free and clear. Very similar. And there's no limit to the number of investors that can be on title with this type of option. So, if you wanted to break that down with 3 or 4 investors, that's doable and something we've seen in the past. And then the last option is using leverage. Investors over the years, a lot of them that have done very well are using other people's money, OPM. So instead of putting all your eggs into one basket with your retirement plan for one piece of real estate, why not use leverage and look at the opportunity to buy not only one, but 2, 3, 4 properties. So again, if you don't have enough money in your retirement plan, you can obtain that non-recourse loan to leverage that purchase. And a non-recourse loan, a lot of you are probably wondering what that is and what's the difference. Well, in publication 590, the IRS states that you can't use your IRA as security for a loan. So it really does leave one option, and that's a non-recourse loan. And this type of product, if you were to ask, Wells Fargo, Bank of America, some of the bigger banks out there, would they entertain this? And they're going to, politely say, no, we don't get involved with non-recourse loans. And so that's why we introduced this product back in 2005. We're a small, mid-sized bank, portfolio lending heavy. So we had a deposit branch customer come to us, and they wanted to buy 2 duplexes in the Kansas City marketplace, but they only had 50% down. But their custodian said they had a non-recourse loan. So we looked into it. We ended up closing those 2 deals. And then we spent the next 5-6 months researching this and realized that there's an opportunity, since the only options at that time were hard money loans or private loans. And if you've ever dealt with those type of transactions, they can be quite expensive as far as the rate you're going to pay in excess of 10%. You may have 2, 3, 4 points tacked onto that. So, we wanted to offer something more competitive and something where these investors dealt with a federal savings bank. So a non-recourse loan, there is no recourse towards the IRA account holder or any other assets you would hold. So if a property does go into foreclosure, the lender only has the piece of real estate as collateral. So we could only take back that, say, single family home and then sell it. And if we can recover our losses, the loan balance, other costs with putting it on the market to sell, taxes, upkeep, then, great for the bank. But if we can't, then the lender can't go after any of your personal assets, like your checking, savings account, a brokerage account, or other assets held within that self-directed IRA. So it does add some protection for you there, where you never want to get to that point, but because of the non-recourse component, it doesn't allow for a lender to pursue other assets. Now, there are some states that tout as non-recourse. California is one. But again, when you're getting a non-recourse loan in the state of California, it's to you personally and not to a retirement plan or another entity. So that's the main difference. So, why would you want to do this? That's why you're on this call. You're looking for different ways to make money within your retirement plan, real estate. Maybe it's something understand. The stock market, mutual funds, stocks, bonds, something that you've been involved with, but you see that there's really that opportunity to grow this tax-free or tax-deferred with some investment properties. So all those net proceeds are going to go back into that IRA. So when you collect rent from your tenant, that, say, $1,000 a month will go back into that IRA and will continue to grow tax-free or tax-deferred. Also using leverage, it's going to allow for larger gains. If, I mentioned instead of buying 1 piece of real estate, you can buy 3. So, if you average out the yield, having 3 properties instead of 1 is going to create that greater gain over time. And then diversification, we all hear it. You don't want to have everything in stocks, bonds. There's other asset classes that have performed very well over time. And I could, argue with anyone that real estate is one that has been lucrative for, since the beginning of time. And, the sustainability of real estate, there's going to be peaks and valleys, just like any other product, or I should say asset class. But real estate has proven to be a good long-term hold, especially with single family homes. So who has the opportunity to take advantage of this? The minimum down payment is 30%. So we lend up to 70% on single family homes. And then we lend up to 60% on your 2 to 4 unit properties. Condos, sometimes we'll go over that 60% threshold. And then multifamilies, which we would consider 5+ units, we'll take a look at. We don't lend frequently on those. Most of our investors are calling in with a interest in a single family home or, let's say, a condo. New construction is a possibility, but we would only get involved with the end loan. So when, say, a single family home is being built in Texas, you would still have to find that builder or that would provide the construction loan, or get some private funding to get that home built. And then once it's 100% complete, North American Savings Bank would come in, provide that permanent financing, and would just be like any existing home that you also fund under your self-directed IRA. One thing to keep in mind, because you are purchasing this within your retirement plan, everything has to be read as such on the purchase contract, your title work, insurance. So when you're making that offer, I always suggest that you make it for 35 days instead of 30 days, if that's the typical time frame in your marketplace. Just because the signature block has to be signed by not only yourself as read and approve, but also by Quest Trust. So if you're buying a home that's in Florida and Quest is based out of Texas, we have to send the closing documents to the title company in Florida. They get sent to you where you read and approve. Then they go to Texas for Quest to execute them, and then back to the title company. So you can see that there's a few extra days required just because of the number of touches. But I don't let that concern you. I mean, it happens all the time, and it's just a matter of the process. But the only reason I mention this is your seller, expectations as far as why you need those extra 3 to 4 days. Just makes things go a little bit easier throughout the process. We do lend in all 50 states. There are a couple states that are a little more challenging. New York is one, just because of the foreclosure laws. We've had some in the past, not with this product, but other loans we've offered where we've had to hold on to those loans for say 5 to 6 years when they're in foreclosure, just because it drags out so long. So, that's the main reason why we avoid some states. But again, it's really limited to 1 or 2, and the rest of the country is an opportunity. Sometimes we get calls about offshore property, let's say in Canada, Caribbean, or some other country. And yes, you can. Now you need to, reach out to Quest and ask them if they would, transact that purchase. But as far as a non-recourse lender, I'm not aware of anyone. You most likely would have to pay cash for that, or look at potentially a private lender that would entertain it. But again, not something that we see frequently, but not an option. Processing time frame, we've already hit on that, just based on how it's vested. In the process itself, we have to order an appraisal with rent comps. So, depending on, the specific area, some appraisals take 7 days to receive them back, where it could take up to 2 weeks in some areas if they're really seeing a lot of transactions being done, and it impacts how quickly things can turn around. The type of loan programs we offer, it's very typical what you're going to see on a conventional loan. We have a 10-year ARM, and then we have a fixed product anywhere between 10 and 25 years. They're principal and interest payments. There is no prepayment penalty. The current rate right now, as of June 17th, is, we're going to be in the low eights primarily. If you look at your conventional rates, we typically average 1 to 1.5% higher. And it is because of that non-recourse component. Banks, there's a little more risk. So there is a little bit higher rate, but again, they're competitive, and, they're still manageable. And as I mentioned, you're not going to find this type of product just at any bank. They have to specialize in it. Cash out refinance. So anybody on the call that already own real estate in your retirement plan, you have the opportunity for a cash out refinance. So essentially the loan proceeds are going back into your retirement plan as cash. So let's assume you paid $200,000 for a property 10 years ago, had no idea that you could get a non-recourse loan, or that was just the best opportunity or, I guess, strategy for you. And then, 10 years later, that property's worth $400,000. You want to take 50% out, so you get a loan for $200,000. So you're using that 200,000 to acquire another piece of real estate or purchase other assets in retirement plan. So there's that opportunity. It's something. This is pretty well kept secret. Self-directed IRAs, and then the non-recourse component is less known than that aspect. So just keep that in mind if you have some that you've owned for a while, or let's say you're bidding against another buyer and time is critical and you want to purchase it with cash just to give you an advantage with your offer. Then we could turn around and refinance that, say 30 days later after title has been recorded with the county and everything is, I guess, a clear title. So again, that's another strategy we see investors use. We do focus on, single family homes, warrantable condos, PUDs, duplexes, fourplexes. We've talked about these a little already. So the next slide, I'm going to mention really what we avoid, and they're considered unique property types. And anytime a lender sees a unique property type, they pull back a little bit, just because if they take it back in a foreclosure, there's less buyers for it. So let's say, one of these listed here is residential with large acreage, say a home on 50 acres. If we were to take that back, it's probably in a more rural area. And then there's going to be a lot less buyers, and we could end up holding it for 12, 24 months just based on, the current market. So these are, if it's unique, a condo hotel where it's maybe 300 to 400 square feet, something we would typically pass on. So, the single family homes, I'd say 80% of what we see, and then we get, a few multifamily 2 to 4 units. And here's how you qualify for this type of loan. So I mentioned in the beginning of the slide, some things I think you'll like about it is we're not looking at your personal income or even ask if you're employed, because we're really looking at 3 things. And that's one, the property itself. We want to make sure that it is in livable, rentable condition. And again, I mentioned we get an appraisal to confirm that. And then the second thing is the down payment reserves. We want to make sure you have those funds in your Quest trust account. And, let's say a 30% down, we would want to see that you still have some reserves left over. What happens if there's a vacancy? Can you sustain that property? Do you have enough funds in your account to do for it? What if you need a new roof or, fix some drywall, deck issues? There's things that come up. So, not having that extra reserve account, that's where individuals have, started to get in a predicament where they don't want to be in. So it's always to your benefit to have those funds available just in case, the unknown does happen. So this is one of the slides, unfortunately, that did not format correctly, and I'll explain this without the use of the slide since it's all jumbled. But so let's say you're buying a $300,000 property and you're expecting $2,500 a month in rent. So that property is going to produce $30,000 in gross annual income. And then we're going to have expenses for that we're going to factor in when we're calculating your DSCR, your debt service coverage ratio. First one, we're going to factor in what are the real estate taxes. So we're just going to presume $5,000. Second would be hazard insurance at $1,500 annually. And the third one is it's a set number that we factor in, and that's vacancy, property manager, and then maintenance and repair at 10%. So 10% of the GAI is $3,000. That gives us roughly $21,000 in your net operating income, or your NOI. And one of those, the property manager, most of our investors we see do use a property manager. especially if they are not located in the same, proximity to the property they're purchasing. And Quest would probably, if you ask them, I think agree that a property manager is a good idea, just because it's hands off. You're not getting involved personally, and it's a lot of cases it's just much easier to let somebody else handle those late night phone calls and issues that do arise with owning some investment property. So on the next slide, sorry for the formatting again, but your NOI is $20,500, and then let's assume your annual principal and interest based on a $195,000 loan. That's going to cost $16,361 a year. So the NOI versus your annual P&I gives you a 1.25 DSCR. 1.0 is the break-even mark for a debt service coverage ratio. So in this case, this would be 25% positive cash flow. And as a lender, we're looking somewhere between a 1.1 to 1.25 minimum, where we consider that a viable investment where you are generating positive income. Because the last thing we want to do, and also on your end, is get into a situation where right out of the gate that this property is going to produce negative cash flow. If these are long-term investments, you don't want to have to dip into your reserves on a monthly basis just to sustain that investment. So we're going to order rent comps with the appraisal. So if, this scenario, we were expecting $2,500 a month in rent, the appraisal may come back at $2,000. And did you have higher expectations for it? Or, is there something that can confirm that $2,500 a month is really a viable option? If not, a lender may ask you to put more money down to increase that cash flow to get it more aligned with what the minimum requirements are. So just know when you're making an offer, make sure you speak to your realtor and have them locate rent comps in that area with MLS or just other resources they have. I think that's a really good first step when you make an offer is know where you stand with the cash flow. And Zillow and Redfin sometimes give you those numbers, but in many cases they aren't as accurate as they need to be, especially with rental income. So again, just something to be proactive about and really do your due diligence for that type of cash flow analysis. The type of fees associated with this loan, we do charge 1 point up front, and then you're going to have your typical underwriting processing fees. The appraisal fee, that's the only thing we would require on the front end, since we're ordering that with your application. With the rent comps, it's going to between 500 and 700 typically. And then we do escrow for taxes and insurance. So all your taxes and insurance must be paid from that IRA. So we're going to collect those on a monthly basis with the P&I just to make sure they are paid, in case something does happen. And if you were paying them on your own, you wouldn't have that slush fund in your account to pay them on an annual basis. So something that's required and it makes sense in most cases. As far as, applying for a loan, I'd say there's a first step prior to that, and that is we have a one-page form. So if you reach out to us, IRAlending.com is the website we use, but we have a pre-approval form. All you're giving us is property address, taxes, insurance, going market rents, and then we'll run numbers on our end, and then we will have our loan committee look at it, typically within 3 to 4 hours. And then if it does meet the qualifications, then the loan officer would issue a pre-approval letter. So you'll have that when you make your offer, which will give you a competitive advantage over some other potential buyers. And then the next step after that, after you've accepted that, I guess the seller's accepted your offer and you go under contract, we'd need a loan application from you. And then, the purchase contract, driver's license, typical documentation. But again, we're excluding your income, your tax returns. None of that is required for this type of transaction. Last slide, and then we'll open it up to questions. We do have a book, Leverage Your IRA. And if you send an email to iralending@nasby.com, we will send you a free e-copy. You can also buy a hard copy at amazon.com, but this is something we give out to anybody that inquires about this type of transaction. It's a good resource for learning about self-directed accounts, non-recourse loans, what are prohibited transactions. So send us an email. We'll get that responded to you. And then we also have an Excel spreadsheet that we'll send you that as far as how do you calculate debt service coverage ratio, all you need to do is input your three components, and that would be the rent, taxes, and insurance. And then everything will auto-populate for you and give you that debt service coverage ratio. So something, if you'd like, again, just reach out to us, iralending.com. That QR code will also take you to that site. And, I always end with, if you want to take this first step, talk to your peers that have done this, talk to Quest about potential resources, learn from experts that have, made this, a viable option where they've made money, and, learn from their mistakes, whether it's a real estate professional or a real estate attorney. There's a lot of individuals out there that have done this. And we find that once somebody purchased their first home within a retirement plan, they typically will come back for a second and third because they see they're making monthly income that, again, is growing tax-free or tax-deferred. And that's why we're all on this call, is how can we avoid paying taxes on investments so we can better compound that over time. And then when we ultimately retire, have more money. So with that, I'm going to open it up to questions. I'll start reading some of the questions that have been added. And let me start with the first one. There was a question, can you explain a little bit further about how California does non-recourse loans? Yeah, and I didn't mean to confuse you there. Just some states tout that they are non-recourse, but technically, they will not offer non-recourse to entities or self-directed accounts. So it's just to be aware that some of the language in the promissory notes are non-recourse, but it's not a true non-recourse for the discussion that we're having this afternoon. What is considered an eligible property versus a non-eligible property from your slide of lending in all 50 states? So an eligible property would be your single family, condos, 2 to 4 units. The non-eligible would be those unique property types like a smaller condo hotel, a farm, storage units we don't lend on. It does have to be a property that is occupied by a tenant. So anything that doesn't fit within that typical box, most likely we're going to pass on. But again, if you were to reach out to us with a specific scenario, more than happy to discuss that with you and tell you on the front end if it's potential or not. Next question, cash out refinance is only 50% of the ARV. That was just the example I gave. It could be greater than that. It just depends on when you purchased it. If you purchased it, let's say 3 months ago for 200 and now, estimated value is 300, we're most likely going to base it on that $200,000 just because there's rapid appreciation. But if you've had it for 5 years and it's gone up substantially, then, we could lend up to 65% most likely of that current value. Next comment, Josh in Dallas. He's looking for buy and hold investors, looking to connect. That's, what this type of product is for. It's not for a fix and flip scenario. So if that's your strategy, perfectly doable within a self-directed account. But if you need the funds up front to purchase and also rehab that home or improve it, private lender is probably going to be your best option. Again, we're looking for properties that at the acquisition date that are in rentable and then livable condition. So it would have to be something that's not distressed. But again, there's money to be made with that type of deal. But again, we're looking for the long-term holds. Next question, can somebody get a loan on land to build townhomes? You can. Now, we don't get involved with land loans or construction loans. So it would have to be a private lender or a hard money lender. And then also, consider that IRAs, self-directed IRAs can lend money. So, within your networking or fellow peers, there may be some others that are willing to lend for that purchase for a construction loan or land acquisition that can be done through a self-directed account. Next question, does the value of my non-self-directed IRA count as collateral? So the only collateral for this type of loan is the real estate itself. So it would not be considered collateral for this loan, but we can use it as reserves. So if you have another IRA account outside of Quest, let's say with a brokerage firm, and it's only invested in cash, stocks, bonds, mutual funds, we could use that as reserves, just knowing that if something were to happen, then you could roll those funds into your Quest account to pay for any, unknown circumstances that arise. Another question, do you lend on multifamily, 5+ sometimes? What are the concerns with 5+ multifamily? I wouldn't say we see it very frequently. Most people call in for 1 to 2 units. We'll lend on 5+ units. It just depends on the specific piece of real estate. We usually have a minimum per door, which would be $75,000. So, you just got to factor that in. We wouldn't lend on a 5-unit that, acquisition price is say $250,000. So we have a commercial department that handles the multifamily, the 5+ units. They have the same, backing as our residential lending. So something we can look at, but has to be the right opportunity. Next question is, can you repeat the 3 lending requirements again? Sure. The first one is the collateral. So the real estate that you're acquiring, does that qualify? Does it check all the boxes as far as what an eligible property would be for this type of transaction? The second one is your retirement plan. Do you have enough for the down payment and reserves? So if you're putting 30% down, do you have that much in your account? And then do you have reserves left over that liquid if something would arise? And then the last thing is the cash flow. Does it meet the minimum cash flow requirements, 1.1 to 1.25 debt service that we had talked about briefly. So those are the 3 main things. And I will say, with this type of loan, it doesn't show up on your credit report. So if you're a seasoned investor, you know how sometimes if you acquire more than 10 properties, it's a little more challenging to get that loan for investment property. So again, this doesn't show up in your credit report, which is an advantage. It's not a credit-driven decision. We're only pulling credit from one of the 3 bureaus just to make sure there aren't any outstanding tax liens or anything that could remove us being in first lien position with the loan itself. So again, those are the 3 things we're going to look for. What if the property is currently rented? How would you figure a refinance? So if you've already acquired this property, have a tenant in place, we're still going to order an appraisal to determine the value and get rent comps, but we have that lease factored in. So we have a documented lease that we can provide to underwriting. So most likely they're going to use that number if it's off a little bit from the rent comps from the appraiser. So that could be a positive for you if you've, let's say, had the same tenant for 2 years and they're paying $2,500 where the rent comps are only showing $2,000. So again, cash out refinance is an option. We can take a look at that also. Last question I see, is there a minimum or maximum amount you lend? Good point. I meant to mention that earlier, and that's, we have a minimum loan size of $150,000. I would say that there's really not a max. Just the larger the property it is, the harder it is to cash flow without putting 40-50% down. So the minimum 150,000 loan size. So you really have to look at, say, $200,000 minimum purchase price. We don't lend less than that amount. But there's lots of opportunities out there for single family homes. It's hard to find a really good rental for less than 100,000, but those cases you can find them. A cash deal might be the best option, or a private lender. Another question just popped up: what if the place is dated but livable? Need to buy it first and update it, then refinance it? Yeah, that's an option. I mean, if it's just outdated, had the same owners for, say, 25, 30 years, they haven't put much money into it to update it. We see that frequently. So perfectly allowable. You could pay for it, update it, and then come back to us for a refinance based on the amount that you've put into it. That's all the questions I have. Is there anything else that anyone, questions, comments?
I think that should be it. Maybe if you can remind us, Matt, if people come up with questions later on, how to find you or where to contact you to ask you.
Sure. I think the slide that's up right now, that telephone number, 866-735-6272, or you can send an email to iralending@nasby.com. That's how you can request a copy of the book. So reach out to us. Happy to help. If you have initial questions or need a little more education, we greatly appreciate our partnership with Quest. We've worked with them for a long time, and they do an excellent job. So you're in good hands there, and we want to continue offering great service to you too for the non-recourse loans.
Amazing. Thank you so much, Matt, for all the great, amazing information shared today. Thank you, everybody, for coming up and, for all your questions and comments. Hope everybody has a great Saturday and rest of the weekend. Again, thanks, Matt, for joining us, and hope to see you again soon. All right. Take care, everybody.